Welcome back, my awesome people. In today's episode, I am interviewing Howard Chan, the CEO of Kurv Invest. Now, this interview is going to have a lot of details, a lot of amazing information, especially if you're an investor looking to prioritize and maximize your gains through covered call strategies. So, welcome, Howard. How are you doing today?
I'm doing great. Glad to be here.
Thank you. Thank you. I know you're a busy person at this time of year. So thank you for chatting with me. Now, just to begin, so can you provide an overview of Curve Invest, its history, its core mission?
Sure. Curve Investment Management is a group of actually former colleagues. We've worked at some of the largest investment management companies around the world. And what we realized and what we saw was there was actually a lot of really good institutional strategies that really isn't available to all investors. A lot of these large asset managers, their clients are pension funds or endowments, and these strategies really, could potentially be in everybody's strategies to reach their sort of investment goal or retirement goal. So we came together and we thought about, okay, how can we make these strategies available? And so we look to really like three different aspects of strategies. One is tax efficiency. So a lot of the reason why these investment strategies are great for institutions is that they use various different instruments, but they're extremely tax inefficient. And it's okay for them because many of these entities are not non-taxable entities, right? So you and I, we have to pay taxes. We're taxable entities. So as soon as we use these strategies, it becomes very inefficient in terms of tax-wise. So we look to take these institutional grade strategies and make it more efficient for everybody's portfolio. The second is we generally use derivative-based strategies. A lot of people still don't have access to things like options because you have to manage your margins. You have to, it requires some sophistication in investing and also risk management. So what we decided is we're going to manage all of that for you, and then we can offer these strategies for, everybody to use in their portfolio through an ETF format. And then the last thing is sort of an expertise of the team, which is we generally look to do cross asset class strategies. So in our portfolios, you look, there are certainly options, and then maybe there's a little bit equity, and maybe there's even a little bit of fixed income. And this is really how professional investors try to eke out additional returns by trying to find different inefficiencies in different markets and put it together in a strategy. So that is really our goal at Curve, which is to make these strategies available to everyone.
And you know what? That's actually a really good point because for the average investor, even a person like myself, when it comes to options and derivatives, it's we don't understand it. However, we do want to get the as much gains as we can from it. Like for example, I know many companies that don't pay a dividend. However, because they are clustered into these certain ETFs and certain option plays are used with them, guess what? Now these companies in the ETF will start paying a dividend. So that's actually a very, very good point. And so what inspired you? So I know maybe you wanted to start this company to give the average investor a better chance. However, was there something, maybe a moment in your life where you decided, you know what, I'm going to start this? So what was your inspiration to start Curve Invest?
Yeah, so I kind of have a tech background, and so a lot of the times, I was trained as an engineer, and the way that engineers think is like you have a problem and you try to find a solution to this. So starting Curve was actually an accident. I am based in San Francisco. I was talking to a few different folks who had issues with managing their own portfolios. And they said, oh, well, you've worked in these asset managers and like, how would you deal with this? I was like, oh, you could do X, Y, and Z, and it would be kind of great in an ETF format. So you can put it in your portfolio, or you could buy it quickly and you could sell it quickly. And then they sort of said, well, why don't you start an ETF company? And I had already built a ETF business in a large asset manager. I was like, oh, this is sort of watching the same movie again. I don't know if I want to do this again. But we realized that a lot of folks don't have access to the things that we've seen. And so it was worthwhile to do that. And that's how we kind of came up with our first suite of product is trying to solve a problem for people in their portfolios.
And that is what many CEOs that I've spoken with who started their own companies have also said, right? They identified a problem, an issue, which is access for the average investor, and they created a solution. So Howard, that is, I'm very happy about that, because now the next thing I want to know is your product of suite. So what are some of the ETFs that you have? I know you deal with Amazon, Google. So can you give us some details about some of the ETFs that your company has?
Yeah. So the first suite, we have a suite of six what we call yield premium ETFs, and essentially they're cover call ETFs. And I'll kind of state the problem that we were trying to solve and access problems, and then how we found the solutions. To kind of go back to what I just mentioned of why we created.
Definitely.
So there's been a problem that a lot of investors face when they buy technology companies. Uh, Technology companies generally don't distribute dividends, or if they do, it's very little dividends. So if you're an income-focused dividend investor, you generally had to underweight technology stocks and overweight the stocks that do provide dividends. So that these tend to be financials like banks, they could be utilities and energy companies. Those generally distribute the most dividend. But if you think about where the world is, those financials, utilities, and energy companies tend to be companies that drove growth in the last 2 decades, like early 2000 in the 90s, and versus tech is sort of driving the growth going forward into the future. So essentially, dividend and income investor have to underweight the future and overweight the past. And that was something that, I don't think anybody would, necessarily think that would be good positioning in their portfolio. And then the second problem was this access. I had mentioned that there's a lot of good institutional grade strategies that weren't available to everybody. So since the 80s, ultra high net worth individuals have actually been writing covered calls in their portfolios to generate additional income. And the reason is because when you start using options and derivatives, you have to put certain paperwork like ISDAs in place that is very onerous. And a lot of advisors don't want to do that for everybody. They will only do that for maybe their largest clients. So they only, would have this income strategy available for people who have wealth that is, greater than X number of million of dollars, right? So our thought was, okay, we can kind of solve two problems at a time. What we can do is we can make these covered call strategies more available to all investors. We'll manage the covered calls within an ETF format, and people can just buy and sell shares of these ETF. And then what we'll do is we'll write covered calls on technology companies so we can generate income on a particular exposure that doesn't actually give any income traditionally. And so this doesn't serve the dividend-focused investor, right? So that's what we were trying to do. And maybe I'll describe a little bit what cover call is. So a traditional cover call strategy is you own the stock, and your view is the stock price is going to not be a tremendous upside. There's not a lot of tremendous upside. So what you do is you sell a call option. By selling it, you receive a premium. So somebody's going to buy that call option, and they're going to pay you a premium. And that premium is actually the extra income that the ultra high net worth individual was trying to eke out to generate in their portfolio, right? So what we've done is we've launched 6 on names that is pretty common household names: Tesla, Amazon, Google, Apple, Netflix, and one more.
Let me find it. We have Amazon, Apple, Google, Microsoft, Netflix, and Tesla.
Tesla. That's right. And um, and so now people can either buy single names or a basket of them to generate some additional income. So generally, what we've seen is the distribution rate for these ETFs ranges from 12% to 30%. The range, it depends on how volatile the stock is, right? So Apple probably is one of the least volatile. That will generally be more in the 12% range. And then Tesla obviously is a much more volatile stock. So people, the price of Tesla stock moves quite a bit. So that is more on the higher range where the distribution rate is close to 25 to 30%. So now investors can use these ETFs essentially to have some tech exposure. So these ETFs are supposed to move similarly like the underlying stock. But at the same time, now you have these call options, selling these call options to generate additional income in the person's portfolio.
And I love that. And I know my viewers love that because Howard, for the past few years, I know dividend ETFs have been popping up everywhere. Almost every asset management company has actually realized that this is a great strategy to have. Like, for example, one of my I would say positions is through Purpose Investments. It is a Canadian asset management company, and they do the exact same thing. They take these companies such as Apple, Google, and Amazon that don't pay a dividend. They add a covered call strategy to it, and guess what? Now there is a dividend, and the yields are also amazing. So Kurv Invest, I mean, viewers, if you're going to look for a 12 to 30% dividend yield, why not go with a company that knows what they're doing, and not only knows what they're doing, but they have a great management team behind them. So can you talk a little bit more about your management team and who's managing, what's your expense ratio, a little bit about why should the viewers trust Kurv Invest compared to, maybe a few others that probably have similar strategies?
Yeah, and I'll tell you a little bit of what our difference is. So the team, as I mentioned very early on, are all folks that I've formerly worked with. So our portfolio management team is led by this gentleman called Dominique Terson. He was actually, and just by background, I helped build PIMCO's, if you guys know the asset manager, European ETF business. And Dominique was actually the capital markets portfolio manager for that particular business. And we counted sort of, oftentimes we get asked, how much experience do you have? Like we combined, I think we have over 100 years of experience. Like I've been in the
Nice.
industry for more than 20 years, Dom's 25, our CCO is like 35, and all the other teams have been in the industry for quite a while. So we have seen, essentially, I jokes like we've seen where the bones are buried, all these large investors, pension funds, we see what they do in their portfolios, how they use it in their strategy, right? So the team is fairly experienced. One of the things that differentiates us is that we generally look for very consistent income. So if you go to our website, kurvinvest.com, you can see the monthly distribution for our ETFs. We know that there is a group of investors who use our ETFs that are approaching retirement, or people who are just really looking for monthly supplement to their income currently. So they want to have this really steadiness and expectation of income. And you can look at our distribution table, is that we're generally much more consistent with our distribution than many other folks that are in the market. And that's actually very intentional. We do a couple of things in our funds that maybe is a little bit different. So you can have choices about how and where you write the calls in your strategy. And we generally write it out a little bit further out in the money, meaning a little bit higher up than where the stock price is. And the reason is this. A lot of people who buy tech, they want some of the price appreciation for tech, right? Like you're expecting these companies their stock price to go up a bit, and that's why you want to have some growth component in your investment, right? But then you also want the income. So we allow in our funds some price appreciation, and then we write the calls at a place where we can generate sustainable income for. So we're trying to get essentially a little bit best of both worlds, balancing price appreciation and income generation. And so our strategy, if you look in early July, Tesla has had a pretty good run. We've captured a lot of that price appreciation. And on top of that, we're able to generate that 25%-ish distribution from the fund. So we're trying to do a bit of both. Many times it is a trade-off. So you can generate much higher distribution, but you clip off the upside a lot more, or you can have a lot more of the upside, but you have much less dividends. So we're trying to find that sweet spot in the strategy. And so right now, we look at sort of and maybe just a little bit of why this is a persistent risk premium. So a lot of large managers actually harvest this risk premium, and it's called volatility risk premium. That's actually, if you see managers who, a lot of them harvest this risk premium to generate consistent outperformance in their strategy. And it's because there's a certain uncertainty that's built into the market, and the market generally is not pricing volatility correctly. So these cover calls, essentially, you're harvesting this uncertainty in the market consistently through options, essentially.
And I mean, that is the point of investing, right? To get as much gains as you can out of your investment. And if you have to harvest your premiums, if you have to, you know, try strategies that might be a little bit riskier than the traditional strategies so you can get those extra gains, then I mean, this is what we're in this for. I think with covered call, it's kind of as you said, the balancing act, right? You have either the extraordinary gains but a reduced distribution, or you have a high distribution but without as much of a gain as you would like. And so other than technology, what other sectors do you see in the investment world, whether it's in the United States or globally? So what other trends or investment trends do you see, or sectors that could be on the come up other than technology?
Yeah, so I think that maybe the most relevant topic of mine is that, and it's still a little bit in technology, but is that year to date, we've had a really nice run in technology sector, right? With a lot of the news, especially with NVIDIA, the
Yeah.
advent of artificial intelligence, large language models, a lot of these stocks has actually, the price has gone up quite a bit, right? One side, people argue, well, we're not quite overvalued yet because a lot of this is earnings driven. So if you look at PE ratio, it's increased slightly, but it's not too out of range. And what they mean by that is that the price increase was justified because a lot of these companies are making a lot more money, right? So they're not overvalued if you look at their earnings, right? And the other side saying, oh, it's been sort of a good run, right? The market has to correct itself at some point. So like, how do we deal with this two sides, right? And so we have an ETF that is essentially coming out today that solves this question that we have. And we actually look at another set of problems that people have really asked us about. And so, we have these 6 cover call ETFs, and some people say, well, I don't want to choose. I don't know how to choose. I want you to choose, right? How do you do that? So that's like the first question. The second question is, there is an inherent characteristics with cover calls, which is it's really not great in an environment where stock prices go up a lot, right? Because you're capping your upside. That's what you're doing with a covered call. You're capping some of your upside to generate income, right? How can I not do this? Like, does it make sense to write a covered call on NVIDIA? Why don't you just ride the stock price increase and then sell a little bit of the shares to get income? Why do you want to write a covered call on NVIDIA, right? So that's the second question we have. So, and then the third question is basically, okay, so we're at all-time highs with technology companies. What do I do if there's a correction? So those 3 questions, like, we're trying to find a solution for. And so what we've done is we have designed what we call the Tech Titans ETF to solve these.
Nice.
And so the Tech Titan ETFs is essentially a basket of the largest technology companies. And we think this is actually a strategic exposure that people should have, we believe they should have in their portfolio. What I mean by strategic is that, this is an exposure that you should have in your portfolio for the long term, because a lot of these companies, and I think maybe a lot of your viewers can see, is that, with the advent of artificial intelligence, large language model, right? They require a lot of capital use, a lot of outlay, right? Because you have to have like huge computes, you have to have huge data sets to train all of these models, right? And who are best positioned to do that are the largest technology companies, right? Google, Apple, right? They're the ones who have the data sets that's training these large language models. So you should have a strategic exposure to this, right? So to answer the first question, which is like, how do I make a decision about which names I should have a portfolio? So we actually pick for the investor the top 15 to 20 names in the market that we think will do well. And we do something a little bit different, something a little bit interesting, which is a feature of technology stocks is that they tend to be growth stocks and they tend to have momentum. And what that means is that if the price goes up, tends to be continuous price increase until there's a pivot moment. And that's what we've seen year to date. So we actually weight the portfolio based upon stocks that have the most momentum versus least momentum. So we have a bit overweight, up to 5% for the names that have a lot of momentum, and then underweight the names that don't have a lot of momentum. So that actually potentially increases additional returns from the basket, right? Because the ones have momentum has had good price returns, so you want to put more in there, right? Now, for the names that don't have momentum, what do we do? That's actually the perfect time to write cover calls, right? Remember when I said cover calls works really well if it doesn't have a sharp price increase over a month. It's really great if the stock is increasing slightly or
like a steady return. Yeah.
Yeah, exactly. So that answer the second question is like, how do I properly use, this is how institutional investors use cover calls. They're a bit more tactical. So we write cover calls on the names that have no momentum, right? So we generate additional income on still a sector that generates very little dividends, right? So that solves the second question. And the third thing, which is actually the most interesting thing, is actually the portfolio automatically is designed to have downside mitigation. So let me give you an example. So let's say the market corrects, right? Many of the stocks sell off, right? They don't have upward price momentum, right? They have downward momentum. So the cover call automatically switches on. So writing more cover calls to generate income, and that income actually cushions the downside. So there's a downside mitigation. So also, when there's a down market, generally the volatility and the uncertainty in the market increases. So we actually expect the strategy to generate more income when there's a down market in the strategy. So we've really kind of went back to the drawing board to think about, like, if we were to use these strategies in our portfolio, how would we actually use it, and how can we design it in a way that kind of navigates different market environments? So like if it's an up market, we overweight, we get the upside, which is what a traditional covers call strategy caps, right? And then when it's a down market, we actually have this income that cushions the downside. So that's our newest ETF that comes out to try to address these problems that we've heard from the market.
Out of all the CEOs that I have interviewed, I have never heard such a detailed and well-explained way of talking about your ETF and how to actually mitigate any downsides. Because writing covered calls on the downside compared to just writing covered calls for every situation actually has a major impact and difference. So thank you for that, Howard. Really, thank you for that. That was actually some really good knowledge. And because you do deal with a lot of tech heavy companies and I guess, in the portfolio. Now that the elections are coming up, how will this affect your business or affect your decision making when choosing stocks? Because I've spoken with other CEOs where I've asked them the exact same question, and they responded that they would prefer to see a Republican leader because there's less regulation, less red tape. They're usually easier when it comes to opening businesses or expanding business. So, what is your opinion, whether personal or professional, when it comes to the election coming up, and how will that affect your company?
Yeah, certainly, we take the approach of thinking about how does this affect our investment portfolios, right? And I think there are probably betting boards that have, chances of which candidate. But in either case, there's not a zero probability of somebody going to win or zero probability that somebody's going to lose, right? So you have to position your portfolio for both cases, right? And one of the things that we're really keen on, and I go back to this volatility premia, is that no matter what, who wins, going up to it and coming out of it, market volatility is going to be higher. If that is the premia exists, that is actually where we should position our portfolios to eke out or harvest that additional premium. So we going into the end of the year, we actually are looking at how we can use option strategies to harvest that volatility premium, right? Like volatility doesn't say who's going to win. It just says the existence of volatility, of existence of uncertainty, right? And
So, regardless of who wins, you're taking
yeah,
advantage
so you
of
want to
that
position your
moment.
portfolio in which you can win under both situations. And going into the election, uncertainty is going to go up, right? Pundits going to say who's going to win, who's going to win. What you want to position yourself, you don't care necessarily who's going to win. You're going to be able to position your portfolio in either case. That's actually how I think good investors think about, is that, obviously everybody has probably preferences about how the election should come out, but whether you should think about, if you're right, what your position is going to do. If you're wrong, how your portfolio is going to do, right? And you want to win in both cases. So that's how I would advise people to think about that portfolio. And the new fund I'm saying, the KQQQ, that's the ticker, looks at that, because there's inherently, it's trying to harvest some market uncertainty. And I think if everything, the market environments turns out the way that we expect, we can harvest that uncertainty in the strategy.
Yeah, can you go more into detail into the new fund that's coming out?
Yeah, so as I mentioned, the Tech Titans ETF, when it's in a down market, we expect that probably there's going to be, okay, let's say one of the candidates win and it disappoints the market, and the market sells off or corrects, right? We expect market uncertainty, or what we call implied volatility in the market, to go up. So that's the time when you write cover calls, because people are willing to pay more premium to protect certain assets that they have. They want to have more rights to have a call or more rights to have a put in their portfolio. So if you're the seller of that call, you can actually harvest that uncertainty in the market. And if the market turns out they got the candidate that they want and there's a rally in the market, the cover call switches off, and that momentum weighting can ride the momentum of that up market. So you're kind of positioned for both scenarios in the portfolio.
So it's kind of like a win-win situation. It really doesn't matter who wins. It just matters that in that moment, the volatility will be so, up and down consistently that you can take full advantage of that. Another awesome piece of information, because even if you're not doing options, you can still use the volatility even if you're just trading simple stocks, because you can see what sectors are probably going to go down or go up depending on, the rumor of the day or the gossip of the day, as the elections get closer. And so your new fund that's coming out, it seems like it's prepared for not only the upcoming elections, but prepared for 2025, because as you know, with everything going on globally, we kind of don't know what's going to happen in 2025, but it seems like your ETF is prepared and well mitigated for anything that comes at it. So if
I want to add maybe one
add to it, of course.
Another way to think about the portfolio is like, what is your structural positioning, right? I think I would think that maybe there's a general agreement that artificial intelligence or any technology innovation is not going to go away, right? So you're going to have a structural position in your portfolio that has exposures to that. So the question is tactically, what is going to happen in the near term, up and down market? How do you navigate that? So the question of like how to tactically position, meaning you have a strategic exposure that maybe is like 10, 15% in your portfolio to this exposure. And then maybe short term it's overvalued or short term it sells off. You do plus or minus 1 or 2%, but you always have the structural exposure in your portfolio, right? So that's like you need to think about, or at least investor needs to think about beyond the short-term noise of elections and what is something that is a long-term theme that's going to be consistent in your portfolio. I think it's hard to argue that Apple is going to go away in 2025 or 2026 or even Google, right? So then it's just how do you deal with the short-term fluctuation of prices? That I think is maybe a good framework that I use in my portfolio.
And you know what? I totally agree because I remember when I first started my investing journey, many investors would say, if you're going to go into the dividend play, don't look at the short term. Just invest. Maybe look at your portfolio once a month, maybe once every few months, unless you're adding to your portfolio. But if you're just going to let it ride, just look at it every few months, or else the dailies will definitely get you into an emotional wreck. And that totally makes sense because your funds are dividend based, dividend prioritized. So looking at it, elections are just coming up in a few months. Maybe next year there might be a global hurricane. Who knows what happens? But as long as you're looking at the underlying importance of the company or the stock, then that's all that matters. And as you said, right, technology, Apple's not going anywhere. Amazon's not going anywhere. They're just getting bigger and bigger. And so as we're looking towards the future, what are some of your top priorities for Curve Invest over, say, the next 3 to 5 years? Are you planning expansion, maybe geographically, maybe looking at other ETFs or stocks from other countries, or maybe you're expanding your ETF suite? What is your priorities for the next 3 to 5 years?
Yeah, so far the first six plus the Tech Titans KQQQ is in the technology space. I think we're kind of done a little bit in this space. I think we've implemented our good ideas.
You've created the Titans. Now it's time to move
Yes,
on to create a
exactly.
different Titan.
Yeah. But there's other spaces that we think especially could remember one of the characteristics of our strategy is sort of tax efficiency, right?
Yeah.
We see actually many different places in cash, in even US equity, where we can have strategies that are a little bit more tax efficient than what's in the market. So those will be the next spaces that we're trying to explore. How can we make either existing strategies better and be good in terms of tax deferral, or how can we do something from a white piece of paper and make something that's unique, that is that can be used by everybody in their portfolio. So that's where we're looking at next for Curve.
Do you have maybe some examples of certain sectors? Like I know technology is going to be in every sector, right? Like healthcare is going to be very technology dominant, very already is. Utilities are going to use technology for efficiency in their oil and gas. But is there some company or some sectors? You don't have to go into detail, but maybe some sectors that you're maybe keeping an eye on that maybe you might jump into?
Yeah, I'm going to talk about something that seems to be one of the most boring part of the portfolio, which
That's the
is
best part.
how do you actually manage the cash that's in your portfolio? So there's a problem right now in the market where the yield curve is inverted. And for those who are not really fixed income geeks, there's a problem, not a problem, but the yield curve right now is actually in a very strange shape that hasn't been in its place for many, many decades. And so typically the yield curve is upward sloping. And what that means is that the more risk, the longer dated the bonds that you hold in your portfolio, you should get more yield because you're taking more risk, right? You need to be compensated for the risk that you're taking. But
Yeah.
right, the yield curve is actually this way. So meaning you're actually paying to take more and more risk, which doesn't make any sense. But that actually affects the way that your cash funds, your cash manager funds are generating yield. So why, if you, right now the base rate is 5.5 or 5.25, right? Like, if you're going to take more risk outside of just holding cash, right? You need to be compensated for it. So how do you do that in this current environment? That would be interesting. And then the second question we're trying to solve is most of the distribution you get from your cash fund is either interest, or if you have, many people don't have probably stocks in their cash fund. So it's mostly interest. And interests are generally taxed at ordinary income, which is your income rates. But is there a way to basically generate some income that is potentially from other sources that are not immediately taxable? So those are the two questions we're working on for a very boring part of the strategy. So we'll talk about more when we're kind of finalizing the strategy. But that's what we're working on right now.
Well, that actually seems really interesting because I know a lot of people, they're probably sitting on some cash and they're probably, want something in return for their cash, whether it's sitting in their platform or whether it's sitting in some type of investment vehicle. So in the future, it seems like ETFs are going to be the new wave because it seems like every time I talk to someone, they're talking about an ETF. They're talking about buying a new ETF or starting a new position in an ETF. I don't hear a lot of people talking about investing in single companies as we did before. Like every time I have many friends who are in investing, and every time we have a conversation, it's, hey, I just bought, an Apple ETF, right? Whether depending on what asset management is from, compared to, hey, I just bought more Apple stock. And it makes sense because most people now are realizing that the dividend play is a good play because you're in the past few years, stocks have tanked hard, and many people were holding stocks that they probably want to sell right away without getting nothing in return. But then right after that tanking, it just shot right back up. So a lot of people, I guess, can't handle that emotional ups and downs and would feel a lot more safer with an ETF. And so looking forward, I have to ask you, what do you think about cryptocurrency? Because there's a lot of these asset management companies that are creating ETFs, such as the spot Bitcoin that BlackRock has created as well, where they're tracking the underlying asset, which is whether it's Bitcoin or Ethereum, and they're getting dividends off of it as well using a covered call strategy or another strategy. For you and Curve Invest, what do you think about crypto? Are you maybe planning in the future a crypto ETF someday? Because I know a lot of institutions a few years ago, they were all saying no crypto, no crypto. And now it seems like crypto is what every institution is trying to jump in. So what are some of your personal or even professional thoughts on crypto?
Yeah, so certainly with the approval of Bitcoin ETFs, we've seen a lot of them, right? I think the last count, I don't quote me, but like it was like 14 of them, right?
Yeah,
So
there's 14. Yeah.
I'm pretty sure the market does not need another Bitcoin ETF, right? Not from Curve, at least. But I mean, it is a very interesting space. It's an asset class that's really driven, in my view, really a pure on demand and supply dynamics within it, right? And then there's certain like halvings and cycles and things like that. So we think, as I've kind of maybe alluded to, is like, if we're going to do a strategy, we want to do something that is interesting. We probably want to solve some sort of issue that Bitcoin investors currently have. We are looking at the space, but we haven't quite. I have to. This is further along because we haven't quite really figured out what would be something that would resolve something, issues that a regular Bitcoin ETF wouldn't solve, right? I mean, there's some that's already generating income based upon the Bitcoin itself, so we don't want to do that again. But there's something about the volatility of Bitcoin that I think would be interesting. So that's probably the area that we're looking into to see. A lot of people hold Bitcoin, they can't stomach the volatility of it. So how do we maybe that's an area where we can try to do something special, and yeah.
So Curve Invest purpose isn't really just to follow the trend. It's like just because 10 companies opened up Bitcoin ETFs doesn't mean you're going to open a Bitcoin ETF. You want to actually identify a problem and create a solution to it. So I'm guessing that is the overall purpose of Curve. Am I correct in saying that? Where you want to think outside the box, find the problem, create a solution compared to, oh, okay, everybody's jumping on the Bitcoin ETF. We should just jump on it too. You guys are more specific in what you're doing and have a purpose towards it.
Yeah, and that's really a very insightful thing to say, because we did launch our ETFs, and I know they're competitors kind of with similar exposures, but the origin story was very different for us. We actually talked to a lot of advisors, and they said, I'm um, I'm at one of the bigger the advisors that are in the bigger houses. There's like, I love to offer this. We have a dedicated execution desk, but it just takes too much time for me to monitor it. And then for
Yeah.
the smaller advisors, they don't even have this dedicated desk. They can't even offer it to a strategy to their folks. So that's the origin story when we launched the first six, even though there were a lot of different competitors in this space, but we designed it a little bit different. And so you're exactly right, was that we launched the six in basically as an answer to a problem, not because there were so many out there or already in the market. So that's right. We want to identify a problem and solve that investment problem. Yeah.
I mean, that's pretty much the purpose of starting a business, right? You find a solution to a problem. And so, Howard, that was an amazing talk. You have given us so much insight, especially about ETFs. As I mentioned earlier, I've talked to many companies who deal with ETFs, but I've never had the type of insight that you provided in this interview. And I know many of my viewers who've been watching all the other interviews that I've had will actually see that. So I really appreciate it, Howard. So Howard, before we end off this interview, if there is there anything else that you would like to say, maybe promote something, maybe I know you talked about the fund that's coming out. Is there any other projects that you guys are coming out with, or this is your time? Anything you would like to say?
I'm actually very excited to be here, because I know for many investors in the US and Canada and elsewhere in the world, a lot of people can't even retire. So I think it's channels like this that, people who are looking to prepare, for retirement, or to make sure to just have enough nest eggs to, live a great life. I think this is a great thing that people are doing their homework and making sure that they themselves are prepared for the future. So we want to be there to help. Yeah.
Perfect. And you know what? That's why I started this channel. I also wanted to help others, using our knowledge and our skills and our expertise to give to others who may not have the same resources or opportunities to learn and hopefully invest. So on that note, Howard, it has been an honor being with you for this past interview. Viewers, this will not be the only time you will see Howard on this channel. I will definitely have him on again. Once the fund is comes out, maybe we can get some more details and other projects that Kurv Invest is working on. So Kevin, have an amazing day. Again, thank you so much. And audience, please subscribe and like, and I will have all of Kurv Invest details in the description box. So if you have any questions, you can definitely email Kurv Invest. Maybe Howard might reply to you. You can email me and we can help you through it. All right. So until next time, stay ranting.